Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for you in light of your financial condition. All information, communications, publications, and reports, including this specific material used and distributed by Blue Line Futures LLC, shall be construed as or is in the nature of a solicitation for entering into a futures transaction. Blue Line Futures LLC does not employ research analysts or maintain a research department as defined in CFTC Regulation 1.71.
Good afternoon. This is Oliver Sloup, Blue Line Futures, coming to you from the suburbs of Chicago. Today is Wednesday, December 3rd, and a little bit of a reversal, particularly in corn and wheat futures. So we'll jump right into the charts. We've got March corn futures pulled up here. Today's trade down 6.5 cents, settling at 443.5. Yesterday's session looked really encouraging. A close out above the 200-day moving average for the first time since November 13th. However, that momentum did not follow through in today's trade. We closed back below the 200 and below the 20-day moving average, which is not a great look going into Thursday's session. If we see continued weakness, something we talked about on Monday, continued weakness below the 20-day moving average takes us to a retest of the breakout point from last Wednesday's big move higher, as well as trendline support in that 50-day moving average. That's going to come in closer to 439, 440. So is today's session mean that we're just going to roll over and fall off a cliff? No, not necessarily. Not a lot of technical damage was done, but enough weakness that could lead to some additional weakness, take us another nickel or so lower. I think this is ultimately one of those trading environments where that's about what you're looking for, 5 and 10 cents. Anything more than that, and you're going to end up probably hitting your head against a wall, just driving yourself crazy, because we're not getting those big trend moves in short times. It's a lot of choppiness and a lot of back and forth. And that's not just for the corn market either. We'll jump over to the soybean market. Soybeans, a lot of back and forth, but more so on the weakness side over the last 3 sessions, back towards the lower end of the risk range and the meat grinder box, which we've outlined really for the last several weeks, probably about the last month. 11.12, 11.16, the low end of that, a break and close below there, and you could start to see the selling accelerate. We've talked about the potential bearish head and shoulders formation forming, and it's basically textbook. It's almost so textbook that it's like it can't possibly be that textbook, and everybody's watching it, so it's not going to play out. But if you're just looking at this chart, this is a pretty bearish chart setup, a break and close below the low end here, and there's some air underneath the chart towards this original breakout point in the 1080s. Obviously above that, you got psychologically significant support near $11. But so far, the chart this week not looking great. The bears, I'd say, have an advantage here in the short term into the back half of the week. Consecutive closes back above the 20-day and ultimately above the top end of this risk range here, 1137 area, is what the bulls need to negate this head and shoulders formation that's been forming for the better part of the last couple of weeks. Now over to the wheat market. Had a nice move higher yesterday. It looks like corn, the candle yesterday, traded lower, then back higher. A lot of black seed jitters, putting some premium into prices, but ultimately today, that premium kind of fizzled out, and we're right back to the 50-day moving average. So we've been trading sideways, as mentioned earlier in the week. I'd like to be optimistic on this market. The chart structure, not super bullish, but we're not really breaking lower either. So I guess that is a little bit of a silver lining. There is a little bit of a gap down here, 528 to 530 from October 27th. Tested and held that yesterday. So long as we can continue to defend that, maybe it's a good risk-reward setup to the buy side. I think options could be a good way to play this market going forward. If you want to try to wait and buy on strength, we're going to want to see a breakout above the top end of this range over the last week and a half and above the 100 and the 20-day moving average. That comes in near 545, 546. Now, moving over to the cattle complex, another higher day. We had February live cattle futures, a $1.10 higher, 221.90. That is $17.60 off of last week's low. So a big move higher. I think that we're probably getting back into some sort of normal trading environment. And one of the things we've been talking about with clients really all week is the big moves higher, the big moves lower, then the big rally back higher. It's like a pendulum, right? You swing a pendulum, eventually that pendulum starts to come in a little bit. And I think that's what we're going to see with these trading ranges and volatility, is see that come in a little bit. I think there's a lot of people just banging the drum saying we're going to rip back higher or we're going to continue to bleed out. I think we can just establish a little bit of a trading range in the mid 220s for the live cattle market, especially if that's where cash finds a home, which it very well may. So buying options, it's tough with the volatility where it's at, especially if you think that we're going to start consolidating. There are some other ways to play it, futures with a combination of options. If you have questions over that, give our trade desk a call. However, chart still maybe a little bit more upside, especially if we get cash to firm in the back half of the week. But I think you get closer to 230 in this February contract, and that's going to be a tall order to get out above. This was the old highs back in the summer. Consolidation, breakout point, that came support, breakdown point, resistance. So that's going to be a big inflection point for the market if we get back up there. If you're a hedger and we get up there, you know what to do. Probably a good time to take some action and protect the downside. Now, over on the feeder cattle markets, very similar chart structure. Big move higher over the last week or so. January feeders, $1.97 higher today, $331.85. That's about $32.50 off of last week's low. So that's about a 10% rally from those lows. We're knocking on the door of these moving averages, the 100 and the 50, and knocking on the door of that gap, only about $9 away. If you're a hedger, again, similar type of thing. I wouldn't be surprised to see us start to come into a consolidation zone. There is a big gap here. Potentially we work our way in there, but I'm not holding my breath that we're going to get all the way filled here in the near future. I wouldn't be surprised to see us fall just shy of that. In our daily livestock roundup, we talked about this 334 area, kind of being the upper end of the risk range. So again, if you're a hedger, maybe a spot to look at playing some defense against this rally that we've had over the last week. And last and not least, lean hog futures, pretty steady day, up 90 cents, 84.72, the settlement there. The first day in 3 days that we've seen just a steady grind higher, which was encouraging. The last 3 sessions, we saw a higher open and a lower close. Not very encouraging. Today's price action, a little bit more encouraging, although the bulls still have quite a bit of work to do to get the chart completely back in good graces. Consecutive closes back above this 50% retracement near 84. That's the first thing to do, and that comes in actually 84.97. Call it 85. Consecutive closes out above 85, I think keeps the door open for a push higher towards 90 potentially. African swine fever headlines continue to float around. It's kind of like the headline risk that we've seen in the cattle market with screwworm over the last several months. I don't think that the African swine fever headlines are going to disappear anytime soon. In fact, I wouldn't be surprised to see them pick up. So headline risk in the lean hogs potentially. Options can be a great way to play that if you want to limit your risk and margin risk into that long position. So if you've got any questions with that, give our trade desk a call. That is all we've got for today. If you have any questions, reach out. Remember, trading futures and options involves substantial risk of loss and is not suitable for all investors.